You are listening to The Vocal Technologist. Spoken tech for your ears.
You know when a major city decides to replace its entire subway system, but they try to do it without stopping the trains?
Right, yeah, like everyone is just commuting as usual.
Exactly. You've got millions of people going to work, holding their coffee, totally oblivious that the tunnels around them are literally being swapped out brick by brick.
The surface looks exactly the same, but the underlying plumbing is just completely ripped out and re-engineered while it's live. I mean, it is a terrifying and fascinating engineering feat.
That is exactly what we are decoding today. Welcome to this deep dive. We've got a massive stack of recent crypto intelligence from late June 2026, and our mission today is to cut through the daily price noise for you.
Because there is a lot of noise right now.
There is so much noise. If you've been feeling overwhelmed by the flashing red and green numbers on your screen, we are focusing entirely on how traditional finance is, quietly rebuilding its plumbing on-chain.
All while the technology itself mutates to accommodate AI agents and quantum computing. We're looking at a series of curated TLDR crypto briefings today, and the scope is just wild.
It really is. We are tracking a timeline that stretches from institutional stablecoin compliance at the very highest levels of global banking, all the way down to offshore regulatory evasion.
Right, and the overarching theme here is friction. It's just massive capital entering a system that, frankly, wasn't originally designed for it.
We have to start with the sheer scale of that capital, because the divergence in the market right now is, it's staggering.
Oh, absolutely.
Like the broader crypto market has recently dropped about 20%. Normally, you'd think everything is bleeding. But the tokenized real-world asset market, the RWA sector, has reached a $51 billion market cap.
Yeah, which is a 40% year-to-date gain, right?
Exactly. And equity tokenization alone is up 130%. The traditional financial world isn't just dipping a toe in. I mean, they are backing up the truck while retail is looking the other way.
That divergence tells a way bigger story than the numbers themselves, We are watching the transition from a market driven primarily by speculative utility, so trading tokens based on what they might do, to a market driven by concrete yield.
Yield is the magic word now.
Right. Institutional money is tokenizing private credit, which actually now makes up 47% of that total RWA value. They're looking for programmable, automated settlement.
And the projections for that automated settlement are astronomical. Standard Chartered just put out a forecast suggesting the AUF token could hit $3,500 by the end of 2030.
Wow.
Yeah, up from its historical hover around $70. And they base this on a $2.7 trillion projected expansion in tokenized DeFi assets. They specifically pointed to Avav V4 targeting the U.S. repo market.
Okay, so the U.S. repo market is this $12.6 trillion daily beast.
Daily. It's massive.
Yeah, it's essentially the plumbing of global banking where institutions lend each other treasuries overnight. But, why is Avav V4 specifically positioned to capture that?
Well, to understand that, you really have to look at how securities financing actually works right now. The current repo market relies on this insane labyrinth of middlemen.
Right. You've got custodians, clearinghouses, prime brokers.
And every single one of them takes a fee and adds settlement latency. So Avav V4 is fundamentally re-architecting its protocol into a hub-and-spoke model.
Meaning they separate the deep shared liquidity, the hub, from the isolated risk markets, the spokes.
Exactly. This mirrors the real-world securities market. You can have a massive pool of stable liquidity, but spin up an isolated spoke for a specific, riskier asset class without contaminating the core pool.
And if they can process even a fraction of that daily settlement on chain, the fee capture totally bypasses all those traditional middlemen.
But here's where the massive collision happens. Institutions want to bring their trillions over to capture that efficiency, but they absolutely require privacy.
Right. Wall Street realized the blockchain is a glass house.
It's a glass house, so they're trying to install smart tinting windows before they move the heavy furniture inside. Morpho is launching confidential lending using Zama's fully homomorphic encryption, or FHE.
And JP Morgan's Connexi's division is moving its JPMD deposit token to live native issuance on the Canton network,
which explicitly restricts trade details solely to counterparties.
Which creates a really profound philosophical tension.
It does. I look at this and think, okay, if institutions bring all their capital but hide all their moves, doesn't that completely defeat the original point of decentralized finance?
You think so, yeah.
The whole idea was a public ledger where everyone can see the systemic risk in real time.
Well, you have to separate what transparency achieves for a retail user versus a market maker. For a retail user, transparency equals accountability, right? Knowing the reserves are actually there. But for an institution operating a proprietary trading strategy, absolute transparency is fatal. If your competitors can see your deposit sizes, your liquidation thresholds, and your exact counterparty selection in real time on a public chain, you will be front-run and bled dry by algorithmic traders all day long.
So the challenge is proving the math works without showing the numbers. And that brings us to the mechanics of fully homomorphic encryption.
FHE, yeah.
If I'm understanding the underlying logic of FHE correctly, it's like a locked, opaque box with those built-in chemical gloves.
Oh, that's a great way to look at it.
You can put your hands in the gloves, manipulate the materials inside the box to build a product, but you can never actually see what the materials are.
That is a highly accurate physical analogy. Historically, if you wanted a computer to process encrypted data, you had to supply the decryption key, run the calculation in plain text, and then re-encrypt it.
Which is a huge security risk.
Right. That momentary decryption exposes the data to anyone watching the execution environment. But FHE allows a blockchain smart contract to perform mathematical operations directly on the ciphertext.
So Morpho's lending protocol can run a check that says, is this specific loan mathematically over-collateralized based on current market prices?
Yes, and the FHE computation returns a simple yes or no without ever exposing the actual dollar amounts.
It allows the mathematical verification of a blockchain to function perfectly while entirely obscuring the financial playbook of the participants. So Wall Street gets to use the rails without showing their cards.
Precisely. But bringing Wall Street's capital inevitably drags the regulators into the room.
Oh, yeah. And the resulting friction is messy. We are seeing strict, rigid banking rules colliding head-on with a technology designed to be borderless.
Look at the Federal Reserve's new proposal. They want to create a specific category of payment accounts for crypto and fintech firms.
But they've slapped a $1 billion cap on them. And they are explicitly denying these accounts access to the discount window or any interest generation.
Which is pretty severe.
Wait, a $1 billion cap in a world where a single DeFi protocol like Aave used to hold $44 billion. That feels like handing out a thimble to bail out a battleship. It practically ensures the big crypto players can't meaningfully use the Fed's system.
Well, from the Fed's perspective, they aren't trying to bail out the battleship. They are trying to keep the battleship from crashing into their harbor. They are terrified of systemic contagion, giving a non-bank fintech firm a direct, unlimited pipeline to the Fed's master account system bypasses all the traditional capital buffers and stress tests that commercial banks are legally forced to endure.
So that $1 billion cap is basically a quarantine zone.
Exactly. They are forcing these platforms into a sandbox to see if the plumbing holds before opening the floodgates.
And the current legal plumbing definitely isn't holding, especially when you look at the freeze authority gap. The data shows the on-chain stablecoin payment volume is sitting around $390 billion.
Which is a massive amount of flow.
It is. Banks are desperate to interact with that volume, and they finally have the protocol-level compliance tools to screen wallets against OFAC sanctions. But if a bank spots a suspicious, sanctioned transaction and halts it on-chain, the existing legal framework completely breaks down.
Yeah, the breakdown happens at the recovery phase.
Right.
In traditional banking, if a bank freezes a suspicious wire transfer, they have the unilateral authority to reverse it or seize it based on a court order.
But on a blockchain, a bank can use a smart contract blacklist to freeze a stablecoin in a specific wallet, preventing it from moving. But the bank cannot retrieve it.
Exactly. To actually recover those funds and move them to a secure holding account, it requires the stablecoin issuer, like Tether or Circle, to execute a burn and mint function.
They have to destroy the frozen tokens and mint new ones in the bank's control, which means control is fractured, the bank has the legal liability, but the tech company has the execution key.
And until that fractured liability is solved, major commercial banks are legally paralyzed. They cannot hold assets they cannot unilaterally control in the event of a federal seizure order.
Which brings us to the most jarring contrast in this entire ecosystem. While the big banks are paralyzed by compliance, prediction markets running on the exact same underlying technology are operating in a completely different reality.
It really is two different worlds.
It is. And it's important to look at this polymarket investigation purely objectively. Regardless of where anyone stands on the regulations themselves, the sheer contrast in strategy here is wild.
Right, we are just looking at the facts of the investigation.
Exactly. The Wall Street Journal published an investigation showing Polymarket paid offshore content creators and streamers, including high-profile names like Aiden Ross, millions of dollars.
Aliens.
Yeah. They were paid to promote fake mirror sites to U.S. audiences. They actively replicated their platform and had these creators simulate wins to circumvent a strict CFTC ban on American traders.
It perfectly encapsulates the bizarre transitional era the industry is trapped in.
It really does.
On one side of the street, you have JP Morgan deploying permission networks and commercial banks begging for protocol-level sanction screening so they can comply with international law.
And on the exact same digital street, you have prediction markets running sophisticated offshore influencer campaigns to explicitly route around U.S. federal regulators.
It is the raw tension between crypto's cypherpunk, permissionless roots and the sterile reality of integrating with global finance.
And that tension is causing internal panic and deep structural shakeups across the ecosystem. Like, the Ethereum Foundation just executed a massive restructuring, cutting 54 staff members.
Which is roughly 20% of their organization.
Yeah, 20%. The stated goal is to decentralize core ecosystem development, pushing the work out to independent teams. But it's not just organizational charts. Protocols are completely rewriting their economic reality.
Right, like Synthetics entirely retiring as SUSD stablecoin.
Yes, they are actively forcing holders to accept vested SNX tokens instead.
The Synthetics move reveals the hidden fragility of synthetic assets. Running a decentralized stablecoin that is backed by volatile crypto assets rather than actual dollars in a bank account is incredibly capital intensive.
You have to aggressively over-collateralize to survive market dips.
Exactly. By retiring SUSD and compensating users with vested SNX tokens, Synthetics is fundamentally de-risking their own capital structure.
But the trade-off is brutal for the user. People who thought they were holding a stable, dollar-pegged asset are suddenly forced to hold a volatile governance token that they can't even immediately sell because it's vested.
And we just saw how quickly that trust can evaporate. Another stablecoin, MSUSD, plummeted 85% in value almost overnight.
And it wasn't even a hack.
No, it dropped simply because its proof of reserves provider, a company called Accountable, terminated their verification agreement.
The minute the institutional trust anchor vanished, the market assumed the underlying assets were gone, and the peg completely collapsed.
It proves that a decentralized asset is only as strong as its most centralized point of failure. If the smart contract is flawless, but the off-chain auditor quits, the asset dies.
Which brings us to Bitcoin's strange behavior amidst all this. It's been stubbornly hovering in the $60,000 to $63,000 range.
Yeah, it's really stuck there.
And what's wild is that it has completely decoupled from the massive boom we are seeing in AI tech stocks. Usually, high-risk tech and Bitcoin move together, but this decoupling is largely being driven by spot ETF outflows and a hawkish Fed keeping interest rates restrictive.
And Zhang Zhou, a prominent Chinese miner, is predicting a bear market bottom somewhere between $42,000 and $44,000 by Q4.
But while retail investors are feeling the pain of this stagnation, corporate whales are quietly eating the network. Bitmine Immersion recently bought another 52,203 ETH.
That is a massive acquisition.
They now hold 5.67 million ETH in their treasury. That is 4.7% of the total global supply, valued at nearly $10 billion. And just from staking that massive pile, they are generating $223 million annually.
Think about the paradox we are looking at here.
I know. The Ethereum Foundation is shrinking its team to promote decentralization, while simultaneously a single corporation, Bitmine, is vacuuming up 5% of the entire global supply. Are we just replacing centralized developers with centralized corporate owners?
Well, the protocol rules might dictate fairness, but the economic reality of a proof-of-stake network is that capital scale dictates influence.
It's just maturation, as painful as it is.
Yeah. We are seeing purist attempts at decentralization, like Aerodrome launching with 0 liquid tokens given to their team members. But the cold, hard reality of institutional capital is that massive entities will centralize token supply simply through overwhelming purchasing power.
But even as these massive corporate whales try to buy up the network, they might end up answering to a completely different type of entity.
The non-human actors.
Exactly. The bleeding edge of this space is being commandeered by AI. 0x Protocol just opened a swap API specifically designed for AI agents.
Using the BY402 standard, right?
Yeah. Yes, the I-402 standard to let agents autonomously pay 1 cent per request in USDC. No human API keys, no credit cards. The AI holds its own wallet and pays for its own infrastructure.
The revival of the BY 402 standard is just this wild piece of internet lore coming to life.
Really? How so?
Well, HTTP 402 payment required was actually an error code built into the fundamental architecture of the internet decades ago. The original architects envisioned a web where micropayments were native, but they never had the digital cash to make it work.
So the code just sat dormant.
Right. Now, crypto is providing this settlement layer. This removes centralized gatekeeping entirely. An autonomous AI agent running a complex data analysis workflow can hit a decentralized exchange routing API, mathematically determine it needs data, pay a penny in stablecoins directly from its own cryptographic wallet, and execute the trade.
The machine is financially sovereign, but giving automated systems sovereign control over capital opens up massive, highly complex attack vectors.
It definitely does.
Look at the infamous MEV bot Jared from Subway. This bot has dominated Ethereum arbitrage trading, extracting millions in profit by being faster and smarter than human traders. But it was just exploited for $15 million through a fake token route attack.
Which is fascinating.
The MEV bot was so hyper-focused on calculating if the math for the trade made sense, it completely failed to realize it was being paid in monopoly money. For all its hyper-advanced algorithmic intelligence, the bot was essentially a highly efficient cashier that didn't know how to use a counterfeit pen.
The mechanics of that exploit are a masterclass in reverse engineering algorithmic logic.
Walk us through it.
MEV, or maximal extractable value, bots are optimized for two things: evaluating the mathematical profitability of a transaction route and executing it faster than anyone else.
Right. Speed and math.
The attacker recognized that the bot checks the math, but blindly trusts the token wrappers. So the attacker deployed counterfeit smart contracts, fake wrapped Ethereum and fake altcoins.
Oh.
Yeah. They then created a scenario where trading these fake tokens looked incredibly profitable. The bot scanned the mempool, saw the arbitrage opportunity, checked its internal math, and forcefully front-ran the transaction to steal the trade.
So the bot intentionally jumped in front of the bullet, thinking it was catching a bag of gold. It approved real WETH to be swapped out for these completely worthless counterfeit tokens.
The attacker didn't break the cryptography. They tricked the evaluation logic.
That's wild.
The bot assumed the tokens were genuine because it was never explicitly programmed to authenticate the actual smart contract addresses of the wrappers against a verified registry. It checked the math, but not the reality.
And it's not just hyper-advanced bots getting tricked. Basic human error is still causing catastrophic damage in this space.
Yeah, as always.
Right. Tyco's Layer 2 bridge was just drained of $1.7 million simply because a single signing key was accidentally left exposed in a public GitHub repository.
Just sitting there on GitHub.
Yeah. But the one that really blows my mind is Secret Network. They lost $4.67 million because of a missing validation check in their code. A vulnerability that had been sitting there completely unnoticed since March 2023. Over 3 years.
It's crazy.
How does an auditor miss a missing validation check for 36 months?
Well, it highlights a fatal flaw in the many eyes theory of open source development.
Meaning what, exactly?
The assumption is that because the code is public, someone will spot the bug. But smart contract auditors often spend hundreds of hours looking for highly complex, theoretical reentrancy attacks or flash loan vulnerabilities.
They are looking for the sophisticated heist.
Exactly. And they completely overlook a missing line of basic variable validation.
Right.
Everyone assumes someone else already checked the front door lock while they are busy installing lasers in the vault.
So we are building the future financial rails for AI and institutions, preparing to settle trillions in repo market transactions, yet a single GitHub leak or a 3-year-old typo can instantly drain millions. The stakes are unimaginably high.
And they are about to get even higher.
Which makes this final piece of intelligence the most existentially terrifying: the quantum threat. There is a new proposal for post-quantum private ETH.
Yeah, this is a big deal.
The stated goal is to prevent harvest now, decrypt later attacks, HNDO. Basically, adversaries are scooping up encrypted private data right now, holding onto it, and waiting until quantum computers are strong enough to shatter the encryption.
Which currently threatens $250 million sitting in Zcash's shielded pool.
Right. And the proposed solution is to utilize hash-based proofs, specifically WHIR and stir constructions, instead of the current lattice-based cryptography.
This requires us to look at why our current encryption is about to become obsolete. Most modern cryptography, including the lattice-based systems currently favored, relies on the assumption that certain mathematical problems are practically impossible for classical computers to solve.
Like finding the shortest vector in a massive high-dimensional grid.
Right. It would take classical computers thousands of years. But a quantum computer, utilizing algorithms specifically designed for quantum states like Shor's algorithm, can slice right through that grid in minutes.
So if a nation-state is downloading all of Morpho's privately encrypted lending data today, in 5 to 10 years, they just feed it into a quantum computer and read the entire history of Wall Street's on-chain movements.
Exactly the threat model. And that is why the shift to hash-based proofs, WHIR and STIR, is critical. Hash-based cryptography relies on the fundamental one-way nature of mathematical hashing.
So even a quantum computer can't simply reverse it.
Correct. It has to brute force guess the inputs. And to defend against a quantum brute force attack, you simply increase the size of the hash. It is mathematically resilient in a way that lattice structures are not.
But this means the industry is literally being forced to proactively patch base layer vulnerabilities against supercomputers that don't even practically exist yet.
Because reactive measures, like waiting until the quantum breakthrough happens to swap the locks, will be entirely too late.
If you connect this back to the beginning of our deep dive, the scope is immense.
Who's all connected?
We are swapping out the subway tunnels while the trains are running at full speed. We are dealing with JP Morgan deploying private ledgers, autonomous AI agents paying for their own data streams, and protocols deploying cryptographic defenses against unborn supercomputers.
All while the legacy legal system is paralyzed over who gets to freeze a stablecoin.
Which brings it all back to you. Whether you are a traditional investor trying to understand where the yield is going, a developer auditing smart contracts, or just someone fascinated by where the global economy is heading, you need to recognize that the plumbing of finance is being radically, irreversibly re-engineered right under our feet.
Yeah, the transition from a speculative retail casino to an institutional automated settlement layer is happening in real time, and it is incredibly messy.
But the friction is the feature, right?
Exactly. The pain of these structural shakeups and exploits is the cost of building a fundamentally new architecture for capital.
Which leaves us with one final, slightly unnerving thought to mull over. We've talked about AI agents autonomously paying for on-chain swaps using forgotten internet protocols, and networks deploying post-quantum cryptography to prevent future decryption by non-existent supercomputers.
It's a lot to process.
It is. We are rapidly approaching a threshold where the majority of on-chain financial activity and the complex security protecting it will be entirely incomprehensible and completely inaccessible to the average human brain.
Which begs a huge question.
Exactly. If machines are evaluating the math, paying the fees, and securing the data against other machines, will the future of finance even have a human user interface? Or are we destined to just become the organic pets of our own algorithmic portfolios? The subway isn't just getting new tracks, it's learning to drive itself in a language we don't even speak. We're just along for the ride.
Spoken Tech for your ears.